Right, friends, this is where we have stopped in the last class, that is economic value added. Okay, let's try to cover this concept now. Say there are two problems with the existing performance measurement systems, whatever you have got. One is whatever the profit that you are calculating, it ignores cost of equity capital. Say cost of debt capital anyway we are reducing in the form of interest, that's reduced by taxes, of course, because interest is a tax deductible expense, you know that already. So profit ignores cost of equity capital. This is problem number one. Problem number two is profits calculated in accordance with accounting standards. Most of the times they do not reflect the real wealth. Why? Because it is subjected to manipulation. This is problem number two. Now, economic value added basically it tries to overcome these two problems. This is the first clarity you need to have with respect to this particular concept. Why? Because always you need to understand the purpose of any concept that has come into picture eventually. You got it? So again I'll repeat. Basically we have two problems, and to cover or solve those two problems, EVA has come into picture. What are those two problems? Problem number one, profit ignores the cost of equity capital. So whenever in any organization, when you guys calculate profit, we don't actually reduce cost of equity. Although we do consider debt, but we don't reduce what? Cost of equity. That's problem number one. So it doesn't really tell you what is the actual value addition that is being happening to the shareholder, because you are not reducing cost of equity capital. See, what you as a company actually earn up and above cost of equity, that is the value addition that a shareholder gets because of investing in your company, correct? If you are not able to reduce cost of equity, then really I'm not able to understand what is the value addition as a investor I'm getting from your company. You got it? So this is problem number one. Problem number two is the profits that are calculated according to the accounting standards. Of course, it's mandatory to do that, but because of a lot of manipulations, they do not really reflect what is the wealth that has been created. So these two weaknesses is solved by EVA, that is economic value added. Now how it is solved, let's try to understand. After that we'll try to solve this sum. Now see here guys, now this will take some time, so I want you guys to focus and listen carefully. So let's come to my notes. Ready? So calculating EVA. To put it very simple, EVA is nothing but NOPAT, net operating profit after taxes. What is NOPAT? Net operating profit after taxes. We'll see how to solve this, minus adjusted capital employed at the beginning of the year. Now every word is important here. It is not just capital employed, it is adjusted capital employed. What do you mean by adjustment? We'll see that later. Not at the end of the year, but at the beginning of the year, into WACC. What is WACC? Weighted average cost of capital. You know this concept already, or we can also call it as KO, overall cost of capital. Is that clear? So you should have learned this in your IPC itself. So I don't think you'll be new to this particular concept. You should be knowing this. So it is nothing but, to put it very simple, as a company, I need money to do business. I try to bring money from different sources of finance, through debt, through equity, through preference share capital, through retained earnings, and each and every source of getting money will have its own cost, right? Now all these costs put together, if I take the weighted average, then we call it as weighted average cost of capital. Okay, so to put it very simple, this is the benchmark rate, or we can also call it as what do you call, a hurdle rate. We can call it as hurdle rate, which means this is the rate minimum that you have to earn. Then you will be at break even, because you will be investing this money and you will be earning some 16%, for example, and you have to pay 16% because that's your cost of capital. Normally the logic goes like this: you have to earn up and above cost of capital to survive actually. Okay, so which means I already have an obligation to pay 16%, so I need to earn something that is more than 16%, say for example 18% or 19%, thereby that spread of 2 or 3% is the profit that I ultimately retain, or the value addition that I give to my shareholders for investing in my particular company. So the decision rule is very simple with respect to EVA. A positive EVA means it is favorable, it's good for the company, because the organization is providing a return that is greater than that is required by the providers of the finance. See, cost of capital means what? For example, cost of equity capital is suppose 15%, let's say. What do you mean by this? Equity shareholders who has purchased equity shares from your company, they are expecting 15% return from you. So their expectations becomes cost for me. So I have to pay 15%, correct? If I'm having positive EVA, it means to calculate EVA, I'm already reducing my overall cost of capital, which includes KE, correct? So if I'm having positive EVA, it means I'm earning up and above the cost of capital, which means I'm going to provide a return which is greater than their expectation, which means it's a very good news for the company as such, right? And for the investors as well, and for your share price as well, because it goes up, there will be a lot of capital gains for your investors, right? So what did we learn right now? First of all, what is EVA? To put it quite a bit simple, it is NOPAT minus adjusted capital employed at the beginning of the year into overall cost of capital or weighted average cost of capital. What is NOPAT? Net operating profit after taxes. Got this? Chalo, now this is the core area that you have to learn. You need lot of adjustments for operating profit and capital employed. Now look at the formula. You have operating profit here. This has to be adjusted before calculating what? Economic value added. And you have capital employed here. This also has to be adjusted. Now that's what makes this EVA calculation little bit challenging. It's not too challenging, a little bit, but this was not covered, you know, in that good way when it comes to your ICA study material. Therefore I gave you my own notes, right? Now chalo, see here. Ready guys? So this I've collected from various sources. I hope this will be useful for you. Now see here. First one is, when it comes to depreciation and non-current assets, what will be your adjustment? So you need to add back depreciation, which means we are basically talking about accounting depreciation you need to add back, and immediately you have to reduce economic depreciation. So basically depreciation I'll reduce, but then if it is accounting depreciation is what you have reduced, then you have to add it back, nullify the effect, because already you have reduced. Now if you add back, the net effect will be 0. Nullify the effect, and again you reduce economic depreciation, which means what is the net effect? It's actually that you have reduced economic depreciation only. What is the reason behind that? Because reducing economic depreciation reflects the true value of assets during the period, is what the opinion is of the Stern Stewart, the guy who has actually invented this particular thing. So his opinion is that if you reduce economic depreciation rather than reducing accounting depreciation, because accounting is a way too strict, is what he feels. So he feels that it actually reflects the true value of the assets. Therefore let's go for economic depreciation reduction. That is first adjustment which you need to make to the operating profit. What about adjustment you need to make to capital employed? Adjust value to reflect economic depreciation and not accounting depreciation. So same logic applies here also. You need to adjust your capital in such a way that it actually reflects economic depreciation only, and also adjust the value to reflect replacement cost of non-current assets rather than book value. So which means if at all you have something called non-current assets, when it comes to your capital, the value of them should be replacement cost, because that actually reflects the today's value of the non-current assets. So what do you mean by replacement cost? I have non-current asset with me today. If I have to buy it today, or if I have to replace it, then I have to buy it and then replace it, which is nothing but today's market price, correct? So replacement cost actually reflects the real value of non-current assets today rather than the book value, which is a historical value. You got it? Now coming on to the second one, provisions. Now if at all you have any provisions, then with respect to operating profits, you need to add whatever the provisions that you have increased in this period. It can be debt provisions, that is provision for doubtful debts, whatever it is, deferred tax provisions, it can be anything, but you have to add them. So if there is any increase in provisions that has happened this year, add to the operating profit. Suppose reduction in provisions has happened, then you have to deduct it. Now I can ask me, why should I add increase in provisions? That can be provision for doubtful debts or anything, or deferred tax provision. Why should I add to my operating profit? Because these represent over prudence in the financial accounts. I told you na, so that Stern Stewart, the guy who has invented this, he was of the feeling that your accounting rules are too strict. That's why he has gone with these sort of adjustments, which actually reflects the real value addition. So he says that if you are reducing the provisions from the operating profit, then what you are doing is that you are being too strict. Over prudence means conservatism. So it is like over conservatism. Conservatism means you are too, you know, what do you call? In native language we can say that unless until a positive really happens, you will not be recognizing it. But whereas negative, even if you have a doubt that it's gonna happen, then you will recognize it. That's the whole logic of conservatism, right? So if there is any loss in future, even that is uncertain, you will recognize it immediately. Whereas if there is any profit, even if it is uncertain, you will not recognize it unless otherwise it is certain. So that's a kind of, you know, prudence concept or conservatism. Now he says that this is too much, you know, these provisions and all these things and all. So therefore you have to eliminate that. Therefore if there is any increase in provisions, you add it to the operating profits. To that extent, operating profit will increase. If there is any reduction in provisions, then you can reduce it. And of course, here also with respect to capital, add back the value of provisions in the period. Now, next. Non-cash expenses, what do you have to do? Add back since they do not represent cash paid and maybe as a result of profit manipulation and not real cost. So, non-cash expenses, they are not really cash moving out from your pockets to somebody else's pockets, correct? Therefore, you just need to add it back. And of course, you add it to the retained profit at the end of the year. That is a adjustment that you will do with respect to capital employed. Next, what about interest paid net of taxes? Interest paid or taken into account when it comes to WACC. So when you're calculating WACC, you'll be calculating weight of debt and you'll be multiplying that with cost of debt. Let's say weight of debt is 40% into cost of debt is normally 8% and tax rate is 40%. Now, you know the formula for KD, right? It is interest into 1 minus taxes divided by net profits if there is no redemption. So which means it has to be interest reduced by taxes, right? Because of interest only, now you are paying less tax. So therefore 8 into 40% tax means 8 into 60%. That will be your net of taxes. So you need to take 4.8 only and not 8%. So that is what you mean. Interest paid net of tax must be taken when you are calculating WACC. So interest reduced by tax savings. Next. What about expenditure on advertising, R&D, employee training, all these things and all? Simply you add back them to the operating profit because you're trying to capitalize the entire expense. Why? Because this expense, whether it is advertising or R&D or employee training, you are incurring for next number of years. It's like a, what do you call, investment, right? So you're gonna get benefit for so many years from hereafter, right? So therefore don't try to reduce it in this year itself, which is wrong. Therefore you have to add it back. If there is any amortization on their part, which means if suppose 50 lakhs of advertisement expense, you're gonna amortize for next 5 years, like 10 lakhs each year, then that 10 lakhs you can reduce if it is mentioned in the question. Whereas whole expenses, don't reduce it, because whether it is advertising or R&D or employee training, the benefits you are going to get will be more than a year. Therefore in the single year you should not be reducing. Therefore you have to add it back. When it comes to capital, increase capital employed at the end of the year to the extent of this expenditure, and increase capital employed in respect to similar add backs of the previous year investments as well. So to put it very simple, just add it back. Okay, just add it back. Don't worry, I'll give you summary also. That should make things quite a bit simple. Next, operating leases. You need to add the lease payments, whatever that you are making, and deduct depreciation on operating lease assets. You'll be really wondering, what do you mean by depreciation here? Because operating lease is quite a bit different from financial lease, whereas here the treatment, if you see, it is pretty much similar to financial lease. There's a logic behind that. See here, what is the adjustment you have to do with respect to capital? Add present value of future lease payments. Operating leases should be treated the same way as financial leases. That means it should be capitalized. Now this doubt is cleared here. Reason why? To prevent firms from using operating leases to reduce capital employed and hence increase economic value added. Okay, so generally what firms will do is that they try to go for operating lease, and thereby if operating lease is there, it will not be, your capital employed eventually will get reduced, which means your EVA gets increased as a, because your capital employed gets reduced means your EVA will be increased, correct? Because EVA is nothing but NOPAT minus capital employed into weighted average cost of capital. So if capital employed gets reduced, then your capital employed into weighted average cost of capital gets reduced, which means NOPAT minus this figure is EVA, which will get increased. So this is the reason why you're gonna treat your operating lease just like financial lease, and as a result, if there is any lease payments, you add it back. If there is any depreciation on operating lease, you can reduce. Okay, now let's come to the summary. If you have any confusion whatsoever with respect to the logics that I've discussed so far, to the extent you can understand, Anna. If you're not able to understand, no worries. You just remember this summary sheet, what I gave you. It's enough for you to solve any sum, any difficult sum. Okay. So summary of NOPAT calculation. See here, very easy. See here. First, you take controllable operating profit. Very important. Because at the beginning of the chapter itself, I told you, when it comes to responsibility accounting, you need to make somebody responsible only to the extent of things that are under his control. This is very important. So controllable operating profit is very important. So all the things that we have discussed only, nothing new, but I'm going to repeat it one more time. Accounting depreciation, you add. Economic depreciation, you should reduce. Increase in provisions, you add. Reduction in provisions, you have to reduce. Non-cash expenses, you need to add. Advertisement, R&D, employee training cost, add. Operating lease payments, add. Economic depreciation, reduce. Decrease in provisions, reduce. Amortization, if you are doing with respect to advertising, R&D, employee training, yes, you can reduce, but total expenditure you should not reduce, you should instead add it back. Depreciation and operating lease payments you have to reduce, and tax paid you have to reduce, but it should be reduced by, yeah, tax relief on interest, because interest is tax deductible. To the extent of paying interest, your taxes will get reduced. That much you should reduce. Okay. So here another important point is tax paid only. So this is given by Stern Stewart. He is the guy. One more time you will revise. See here the summary of NOPAT calculation. Controllable operating profit is what you have to take. Add accounting depreciation, reduce economic depreciation. Add increase in provisions, reduce decrease in provisions. Add non-cash expenses. Okay. Add advertisement, R&D, employee training cost, whereas reduce amortization of the same advertising, R&D, employee training cost. Add operating lease payments, reduce depreciation on operating lease payments, and reduce tax paid. Of course, you need to add the tax relief on interest. Got this, guys? I hope now once, because of this notes, it should be quite a bit easy. Once we solve the sum, you'll understand that this kind of learning will make things really easy for you. Okay, so copy this notes, Nana, and then we'll solve problems. Okay, copy from here. Pause it and copy, guys. Copy. Now copy this. Done. Copy this. Copy this one. Next. Copy this. This. Okay, now this one. Then this last. Okay. Right, guys, let's solve the problem. Now take question number 1. Ready? So XYZ Limited provides you with the following financial information as at 31st March 2018. Share capital is given, reserves and surplus is given, long-term debt, trade payables. Additional information provided is as follows. Profit before interest and tax, this much. Interest paid, this much. Tax rate 30%. Cost of equity 12.42%, and cost of debt is 6.53%. Okay. So you are required to calculate economic value added of XYZ Limited. That is the question. As usual, Nana, read the question. We'll start solving. Read the question, guys. We'll start solving. Done? Chalo. We know the formula. Now look at the question, all of you. Calculate economic value added of XYZ Limited. We know the formula. Economic value added is equal to NOPAT, that is net operating profit after taxes, minus adjusted capital employed at the beginning of the year into weighted average cost of capital. This is the formula. We are aware of it. Just now we have learned the concept. Okay, now let's calculate NOPAT first. So working note, NOPAT calculation. Always follow this series. First always calculate NOPAT, then we'll go for capital employed. Ready. Coming on to NOPAT calculation. Now look at your question. I'll go with 2 columns. Particulars, amount. Okay, coming on to particulars. First we have profit before interest and tax. So all the rupees will be in lakhs. Kitna re? 2202.84 lakhs. From this, let's reduce interest. How much is interest? Interest paid is 13.4 lakhs, directly given in the question. 13.48 lakhs. Then you'll be getting profit before taxes, or EBT also you can write, earnings before taxes, your wish, which comes around so it's gonna be 2202.84 into, sorry, minus 13.48, 2189.36. From this I need to reduce tax at 30%, so that will be 2189.36 into 30%. So it comes around 656.81. So I'll be getting profit after tax, which will be 2189.36 minus 656.81. So 1532.55. Then I need to, as I told you, add back what? Interest net of tax. So which means your interest is actually 13.48, but don't add 13.48. In that your tax savings will be 30%, which means you take 70%. You need to add back 17%. So 13.48 into 70%, 9.44. So which means your NOPAT will be 1532.55 plus 9.44. Okay, 1541.99. Okay, that's your NOPAT. Okay, we got NOPAT right now, so which is 1541.99 minus. So what is your adjusted capital employed? What is your WACC? Okay, let's start with capital employed first. Capital employed. Now moving on to your capital employed, what is the information that has been given in the question? Share capital, reserves and surplus, long-term debt, correct? So capital employed is equal to share capital plus reserves and surplus plus long-term debt. That implies, what is your share capital? 981.46 lakhs plus 1313.62 lakhs plus 144.44 lakhs. That implies 981.46 plus 1313.62 plus 144.44, 2439.52 lakhs. So this will be your capital employed. Now I need to calculate WACC. Chalo. So calculation of weighted average cost of capital, or we can also call it as overall cost of capital. Okay, so how to calculate that? Very simple. You have share capital and reserves and surplus. Now, okay, let me go with this particular column. First column will be types of capital. Next column will be amount, percentage, that is percentage, proportion, percentage. Next, cost of capital. Last column will be multiplied value. This is the way we used to do, right? Types of capital, what you have got: share capital, reserves and surplus, long term debt. Correct only na? All right, chalo. So share capital, what is the amount? 981.46. Reserves and surplus 1313.62. okay. Long term debt 144.44. So coming on to total, already we have calculated it, 2439.52. so percentage proportion will be 981.46 divided by 2439.52 into 100. So 40.23% approximately. Okay, next, what else you have got? I'll remove the percentage over here. 40.23. next, 1313.62 divided by 2439.52 into 100. 53.85, right? Next, 144.44 divided by 2439.52 to 100. 5.92. Does it tally? 40.23 plus 53.85 plus 5.92, exactly 100. Now cost of capital, share capital. What is the cost of capital? Cost of equity is 12.42%. so it will be 12.42% for share capital. Reserves and surplus also, if there is lack of information, this is KE and this is KR. So when there is no information, cost of equity will be equals to cost of retained earnings. Okay. Long term debt, as you know, it is 6.53% is the debt that has been given. We'll presume that it is reduced by taxes. Because otherwise this kind of number you will not be having. 6.53%, correct? So we'll presume that this is after tax reduction. Okay, now let's go for the values. So 40.23 into 12.42%. so 4.996, something like that. Let me take it as 997. Next, 53.85 into 12.42%, 6.688. 5.92 into 6.53%, 0.373. so what's gonna be your KO? 4.997 plus 6.688 plus 0.373, 12.058, 12.06. little bit of approximation will be there. Okay, 12.06%. so finally, so what will be your adjusted capital employed? It is 2439, correct only na? 2439.52 into what is WACC? 12.06%. So if you do this, your answer is going to be 1541.99 minus 2439.52 into 12.06%, 294.206. That implies 1541.99 minus 294.206 comes around 1247.78. This is your EVA, 1247.78. Approximation will be there, chalta hai. You got this? Quite a bit simple sum here, except for interest reduced by net of taxes. There is no challenge for you to calculate NOPAT, but there are two more sums for you in your study material, which is not going to be this simple. Okay, there will be solving some very good sums based on EVA, but not now, after completion of remaining concepts as well. You got this? Chalo. So with this, we are done with this particular class. Thank you.